think about what else you can do with it. As part of that, there's a new word out there, which I assume has reached Utah already, which is pivoting. I mentioned this at a talk a few months ago, and a reporter from The Economist was in the audience, and he thought it was so important. He'd never heard it before. I don't know why. I mean, it's been around for a reasonable amount of time. I would say it wasn't there 2 years ago. It's not that old. It's probably the last year. But he hadn't heard about it, so he wrote a whole article in The Economist about pivoting. So at least for him, it was something new. But each thing I say to you, I could say is the most important thing I'm going to say, but I think it's really, really important for companies at the stage that I saw today, for most of them, and I'm sure probably more so for the ones in the other room, in the healthcare area, and that's pivoting. Whatever you start out with today, my guess is the chance half of you will not do the same, will not be doing the same thing in 6. I don't mean you'll get another job. I mean the product or the service or the way you're doing it. In 6 months or a year, if someone sees you, it will be totally different, and you will have pivoted. It goes back to what I was saying about, don't be stubborn, but this is more than that. It's learning as you go. I was at a meeting a couple of months ago of a venture firm that had six startups on stage, and 6 of them made their presentation, and 3 of them I just knew we had seen in the last 6 months or so, and I was really excited by these 3, and we had seen these same 3, and they were doing something entirely different when we saw them, when we turned them down. If we'd seen them doing what they were doing now, at that time, we would have probably been much more likely to make the investment. So they had learned in the process. I'm sure you're all familiar with Techstars in Boulder. We've just opened a new Techstars in New York, and the people who run Techstars were telling me that in the 3-month period they're in Techstars, we come back, I'm one of the mentors, that in 3-month period, as a result of the mentoring and conversations, they will have changed their business model and be different than what they set out to do. So don't be stubborn, learn, and be open-minded. Being first today is very important, but if you can't be first, you at least have to learn how to use the web and how to use the social networks, because you have to get your message out quickly today. You just can't depend on taking an ad, spending all that money, and spending money on SEM. You have to learn how to use Twitter and Facebook and Tumblr and anything else you can find to get that message out and to create something viral. Things are moving too fast. When you're raising capital, and this is not meant to be self-serving, I promise you, but don't focus on just the money, but really focus on the benefits that come along with the money. There's a lot of money out there. In fact, I meant to start out this talk by saying to you, in the 40 years I've been in business, I have never seen such a vibrant startup, early stage environment. But there's a lot of money around, and there are so many entrepreneurs, and there are so many startups. It's a very, very exciting time. So I think that entrepreneurs, it's a struggle to raise money, but don't get carried away by the first person who walks in and just hands you a check. If you have enough self-confidence, and if you got the team, if you have all the other ingredients I mentioned, discipline yourself to, do your own due diligence on the investor, because they're going to do it on you. You do it on them also. There's nothing wrong. No venture capitalist should be upset if you want to call some of his or her CEOs. This is a no-no. I get lots of controversy, but I'm just giving you my opinion. Don't waste your time getting people to sign NDAs. It's a waste of time. I don't sign NDAs. We don't sign NDAs. A lot of firms don't sign NDAs. And I have seen more people raising money and waste so much time because some banker or some advisor said, you got to get an NDA before you send them anything. No one steals in our business, honestly. I've been in this business 40 years. I have never, and I'm sure if anyone here disagrees with me, raise your hand. I've never heard anyone, any venture capital, any investor steal an idea. It's tough enough to be an investor. If you think we want to run these companies, you're out of your mind. We wouldn't know the first thing of what to do, how to run Matchbin, I can tell you that. Unless you're dealing with a strategic investor, that may have a difference. You know, if you're dealing with a corporation and there are certain issues, I would modify that statement. There may be certain circumstances where you want to protect yourselves, but not from financial investors. I also think, don't get carried away with the idea of patents. I have yet to come. Every time we've invested in, people say, if it fails, we can always sell the patents. The patents always have a value. The patents will have more value than what you're investing. In 40 years, I don't think the most I've ever gotten from any selling of any technology is more than $250,000. So don't count on patents. I mean, I don't mean you shouldn't file them, but don't carry it away about your own importance or self-importance because you have a patent, and don't spend an enormous amount of money or time trying to get it, but also recognize it for what it is. The only way a patent is valuable is if you're prepared to spend a lot of money and a lot of time to sue everybody. I can tell you, I'm involved with one company that we started in 1990 that's been an enormous success, and its cost of goods today is 17 lawyers on staff, and I'm not exaggerating, it's 17, who are constantly attacking someone who's violated their patent or someone who's sued them because they say their patent infringes. You have to be prepared to sue and be sued and spend a lot of money. And most young companies aren't prepared to do that. Boards, don't get hung up on boards and board control. Waste of time. Part of our firm, and I won't go through all the principles we have, but we have a very unusual approach because I learned from 35 years in the business. We don't require board seats. We don't require a lot of things. We always co-invest. We don't have a certain minimum percentage. We got rid of all those hangs. We don't spend 5 minutes on registration rights because you can't go public anyhow, so why waste your time? And I can tell you the number of companies that have spent days while they're raising money negotiating registration rights for. I've never exercised a registration right in 40 years. Never. Not even once. So why spend all that time? But in terms of boards, we don't require board seats. And when we were raising money for our fund, the investors said, well, how can you control a company if you don't have a board seat? And I said, how many? I'm not going to play this with you because I know the answer. I would normally say to everyone in this room, how many of you have been on a board where the vote was 5-4? You'd never get it. Anyone want to prove me wrong? Anyone want to raise their hand? It doesn't happen. But people fight for this board control. When almost all venture deals, the management in some way or other initially has control because venture people are minority investors for the most part and don't have control, and there's no point to fight for it. The only way you get to control is if you have to do an A, B, C, D, and E rounds, and at that point, either the CEO's not there or you've certainly gotten more and more board rights to do something because the company's not doing well. Also, don't raise more money than you need because that's a great temptation today. And the flavor of the month is participating preferreds, and I can tell you they come back to kick you in the ass. So if you raise less money, give less dilution, there are lots of entrepreneurs today are carried away by $15, $20, $25 million pre-money valuations that deserve 2 or 3, and the person coming in is going to put in 10 million because they have to. The venture fund has to put 10 million, not because the company needs it, and they've got 3-time participating preferreds, and you set yourself up unnecessarily for a lot of problems down the road. Use the benefit, and I guess that's the reason I didn't go in the healthcare section, because I have to admit that we have had a long history in healthcare, and it's been a difficult area, particularly because we had a lot in the biotech area. We focus on capital efficient businesses, which are primarily today in the internet and the wireless area. And it's wonderful. I mean, to take advantage of the internet, to take advantage of cloud computing, to take care of very cheap bandwidth. This is very different than what you could do 10 years ago. And I urge everybody in that to take advantage of all those features, to reduce the amount of capital you need and the amount of fixed costs you have up front, retain more of your company, be able to raise less and get going. I said that just a second ago, lots of venture firms today have minimum investments. That's why I started Graycroft, and without a minimum. Had built a very, very big firm, Apax Partners, which is an acronym in my name, which is all over the world, and we got to the point where we were managing $40 billion, believe it or not, and we left venture behind a long time ago, and they do only mega buyouts. And a lot of firms in the venture business have moved from 5 million to 10 million to 25 million minimum size investments not because the companies necessarily needed it, but because it's a natural fact. As your firm gets bigger and bigger and you get more funds under management and subsequent funds, you have to invest. You've heard it say, I'm sure some of you had this, who need $500,000. You've heard somebody say, you're too small, it's not big enough for me to be interested, my minimum size is something. But that's the fact of it. So I would say, don't let their problems be your problems. Another thing is have realistic exit expectation. I've written a lot, and some of you may have read some of the stuff I've done. I believe very strongly in the fact that the small company IPO is gone. You mentioned Bill Hambrecht. Bill Hambrecht would tell you the same thing. Bill's terrific. He's like the dean of this business. But all the companies that took small companies public are gone. They don't exist anymore. The market makers are gone. The research people are gone. The underwriters are gone. They have the same problem. Goldman Sachs' minimum offering today is probably $50 or $100 million, and the company therefore has to have a valuation of $300 or $400 million. And I use the number that you have to be able to have an offering of $50 million and have a total market value of $250 million to even consider going public today. And with all deference to all of you and all your terrific companies, I would guess there are very few in this audience who are going to build a company that will be worth more than $250 million in a reasonable period of time. That's the thesis of our firm. We assume that every company we have in the portfolio is going to get sold at under $100 million because the average sale in the last 10 years has been $70 million. So if that's the fact, why kid yourself? And if you look at the transactions that Google was doing or Facebook or anything, they're buying every acquisition, AOL, they're 20 million, 30 million, 40 million. We've sold 6 companies since we started the fund, and except for one, which was sold 2 days ago, and is the exception. And let me tell you, I may have said what I just said, but believe me, in our heart of hearts, we hope we have several that are going to break through this 100 million. But when we make the investment, our exit assumptions are it's going to be sold for under 100 million, which dictates the pricing valuation and when we go in. But we got lucky. So be realistic. Don't think about IPOs. Assume when you get exit, it's going to be in an acquisition, and think that in terms of your pricing, in terms of your own stock ownership, and so you can extrapolate what you can expect to get.